embarrassed to say that the economy is not in recession for me, because compared to the last few years, now on my deposits, I get 5% return. And before I got less than 1%. So for the rich people like me, the economy is not in recession. But for the lower income recipients, say you can structure your society in the 20% lowest income recipients, 40% lowest, 60. For the 60% of Americans, their wages and their income, inflation adjusted, and inflation adjusted by people like John Williams, who actually calculate how much a household spends on this and that and so forth. Or the Kopok index. In these terms, 60% of Americans are less well off than their parents were 30, 40 years ago. And the last few years have been disastrous. The Fed will tell you, oh, we've beaten inflation. Nonsense! The cost of living today is approximately 30% higher than in 2018. That hasn't come down. I agree that right now prices are going up at a lower rate than before. But the prices haven't come down. The home prices are still high. And you pointed out, talked about home prices. The result of high home prices is that most Americans can't afford to buy them. That is the problem. They can't even afford to buy the groceries. Irving Fisher, who I regard as one of the most important economists, I'm not talking about his character, because he was a president of the Eugenic Society in America. But I'm talking about his ability as a monetarist and as an economist, not as an investor. He wrote about the monetary illusion, the money illusion. It's very important to understand, when you print money for a while, people feel wealthier and so forth, and there is a boom during the process of money printing, but very shortly it changes, and that is the viciousness of inflation. You can have for a while home prices and stocks going up, and then suddenly consumer prices go up, and suddenly commodities go up. It's not, and this was observed by Copernicus already, because he was actually, he wrote economic books as well. It's not that the price level goes up evenly in a society. No, it goes up here and then there and so forth. So members of society get hurt at different times. But the Fed, one quality they have, they will always protect their friends on Wall Street. That you can bet upon. What the single worker does in the factory in middle America, they don't give a SHIT about. That you can be sure. I think this is a very intelligent question. And we have to consider that there is no clear-cut answer to this question. For the real economy, for the people who work every day, they are farmers, they are working grocery stores, they are people that borrowed money to buy a home, they have children, they pay fees to send the children to schools or to kindergarten and so forth and so on. For these people, interest rates should be cut. But I've never seen a central bank cutting interest rates when the stock market is near an all-time high, when Bitcoins was moving up strongly, when gold was making new highs, and when there was still a huge quantity of liquidity in the system. There's no liquidity crisis at the present time. It's just that the liquidity has begun. I wrote now 3 reports about turning points in asset markets. Whatever happens, I think we are at a very important juncture where stocks of the popular sectors, semiconductors, the FANG stocks, the Magnificent Seven, and so forth, they are going to sleep for the next few years, and they will sleep very deeply, in other words, by going down. And other stocks, value stocks, will tend to go up. And other markets around the world, notably emerging economies, will start to move up in their performance. Because this is what the history books, financial history books, bank credit analysts, and I followed their services for the last 50 years. It's a very interesting, organization like Alpine Macro. They do macro work. They published a chart showing the market capitalization of the Magnificent Seven stocks and the market cap of all Chinese stocks, including Hong Kong. The Magnificent Seven have a higher market value than the market of a country with more than 1 billion people and some very successful companies. That's why the American State Department is always embargoing these companies. Well, my view is simple, and I'm not a technology analyst, but in the world of investments, there are some principles that have, in the long run, provided higher rates of returns. Say, Warren Buffett and Charlie Munger have not been much more intelligent than other people, but they have been more disciplined and more focused and especially more patient than other people. And their philosophy was always to buy assets when their market price was selling at the discount of the intrinsic value of these assets. Say, you have property companies. The property companies, they have a value, a net asset value, but the property stocks, they frequently drop way below the value of the existing properties. And at that stage, they become attractive. Similarly, growth stocks, they occasionally become attractive. Like technology stocks in the early 1990s were very cheap, or technology stocks in America in the years 2003, 2005 were cheap because investors at the time were focusing on other sectors and the Nasdaq had declined by 70%. But this is not the case now. Now, technology stocks must deliver miraculous returns to justify their valuation. Miraculous. And I can tell you, in technology and in everything, you'd always be surprised how many new technologies come up and compete with the existing technologies. So I wouldn't touch a single Magnificent Seven stock, not one. I don't have any one. But I want to remind my readers or viewers that when the asset markets go up, everything goes up, but some assets go up more than others. When the asset markets go down, the tendency is for everything to go down, but with some assets going down much more than others. So now I can argue, well, in this environment you should own gold. Yes, but I tell you, if the asset markets go down meaningfully, gold will probably also go down, but less than the other assets. If I knew the catalyst, you would know it as well, and everybody else would know it. We never know precisely in advance what the catalyst could be. But I can tell you, if I look at all the potential wars that we have, I look at, say, nobody in the world, and even experts in real estate, expected commercial buildings to collapse in the US by 50%. Nobody expected that. And it happened. And I know many people who are involved in real estate. They're billionaires. They own properties like no incredible quantities. But it happened, and you never know why. And I'm not saying the US market will go down by 50% in nominal terms, but I think it will go down at least by 50% in real terms, inflation adjusted. That I am quite sure about. Minimum. When the Japanese market was 50% of the world's stock market capitalization in 89, I placed many bets, including in put options, that the market in Japan would drop by 50%. I was much too conservative. It dropped by 70%.